We've spent some time here talking about stocks and bonds and valuation and discount rates. What I want to do is step back and take what we've done the last couple of classes, last 3 or 4 classes, and work through some examples. These are examples from an exam from last year. It will be similar to what the final exam for this class will look like. So we'll go through these problems, give you the exam review. I'll have some other YouTubes that do similar problems, but just to give you get some practice on what we've already done. So this first question, I'm using Nordstrom's, JWN. It's a fashion retailer, higher end type of products. So that gives you some sense of when we're talking about, is this a cyclical or defensive stock? It's probably more on the cyclical side. So the first thing we want to do is come up with their equity discount rate, the KE. And so to do that, we need a few things. So here's the data that's given, giving some information on the company, given the chart on debt to equity and net margin standard deviation and the rolling beta chart. And so how can we come up with the discount rate for this stocks? So remember, using CAPM, that the discount rate for a stock, we call it KE, is the risk-free rate plus beta times the market risk premium. So let's look through that. So the risk-free rate, you're working on paper 2 right now. So the risk-free rate, your boss gives you some information on here about how she handles that. So she says she was using the forward curve for risk-free rate when the 10-year forward 10-year treasury rate is 3%. So I told you a few ways to use the risk-free rate. One way is to use the actual 10-year treasury as reported. One approach we talked about was normalizing it. And then another approach was use the forward curve. So she's using the forward curve, so you just use the number. It's very simple. She said she used the forward 10-year treasury. Whatever information I give you will be related to the 10-year treasury. You either use the actual 10-year treasury, a normalized 10-year treasury, or the forward. So here that's 3%. So we can put that into the formula. Then we got to come up with the market risk premium. Well, the market risk premium is going to be the expected return on stocks minus the risk-free rate. The expected return on stocks, so you just have to remember these things. We're using the approach that does the dividend yield plus expected earnings growth, and we know expected earnings growth right off of exam 1 is going to be a function of economic growth, which equals, if you remember, productivity growth. So don't forget everything you learned on exam 1, plus labor growth plus expected inflation. They're all expected. So let's see if we can fill some of these numbers in. So she calculates the expected or nominal GDP growth as the sum of productivity growth, 2%, labor growth, 1%, and inflation, 2%. So that's 5%. And she thinks nominal earnings growth for corporations will be 5%. So her 5% expected growth for the economy ties in with their expected growth economic earnings for the economy. The current dividend yield for stocks is 2%. And there's a buyback yield adjustment. Well, we talked in class, some people make that adjustment. She says she's using it, so if she says you're using it, you want to add it back. So the dividend yield is sometimes adjusted for the buyback yield. So in this case, the dividend yield is 2% plus the buyback yield is 3%. So the expected return on stocks then is going to be 3% plus the expected growth in corporate earnings of 5%. Here, she just came out and told you, but we got the three pieces here. That equals 5%, but you notice that she told you her expected GDP growth is 5% when you add those three numbers together. And she just came out right out and told you what her nominal growth in earnings is 5%. So she essentially gave you the 5% twice. So that means the expected return on stocks, if you put all that together, is 8%. So our market risk premium then is going to be 8% minus 3%, or it's going to be 5%. So we've got two of the numbers in there. So we've got 3% plus beta times 5%. So here's our market risk premium. And we got the risk-free rate just from her just telling us that number. So all we got left to do then is to get beta. So beta, we know you have 4 steps. The first one is revenue sensitivity. So is JWN a cyclical or defensive company? I'm going to say they are a cyclical company. They sell higher end retail products. So this is an above 1. This isn't Walmart. It's not a discount store. It's not Family Dollar. It is higher end. It may not be Tiffany's, but it is definitely higher end. It's not a cruise line or an airline, but it's definitely higher end, above 1. So beta above 1. Not saying it's dramatically above 1, but definitely above 1. The second thing we'll look at is financial leverage. And so what do we notice that? We're here, their debt to equity, you notice is 280%, much higher than the S&P. So their debt to equity is well above the average stock. So pushes beta higher, further away from 1. So that's, if we have a range on beta, we think it's maybe between 1.2 and 1.5. This high debt to equity is going to push us closer to that 1.5. The third thing is operating leverage. Well, for a firm like this, I'm going to assume a lot of hourly labor. They probably pay the workers a little bit better, but it's still hourly labor, which implies low operating leverage. And then looking at the standard deviation of net margin, what can we say about that? So we look at that. We notice it's only right at 3%, 2.98%. It's much lower than the S&P 500. It's much lower than the average stock, bringing beta back down closer to 1. So we've got number 2, financial leverage, pushing us up away from 1. We've got number 3, operating leverage, pushing us down closer to 1. So number 4, we look at the history. And what does the history imply for us? So when you look at the history chart, you notice their median is 1.4. You notice their recent history has been well below 1. Part of that's because of what's going on right now in markets where technology and energy are really dominating. I think the 1.4 seems reasonable to me. Implies 1.4, the median. And one thing that's real important to say, this is consistent with the revenue sensitivity and operating and financial leverage. So I'm going to go with 1.4. That's what I'm looking for in an exam and a discussion like that. So if I use a beta of 1.4, and that will give me my final beta. And we'll give me my discount rate. So 3% plus 1.4 times 5, 1.4 times 5 should be, what is that, 7%? So 7% plus 3% gives me a discount rate of 10%. So there's my discount rate, and that's what I'm going to use in the next problem. That's my answer, and that's your answer for question 1. If you do all of this, you would get full credit on question 1. Coming up, and that's what they're asking for. Determine your beta, and then apply that to CAPM to get your equity discount rate. So there we got a discount rate for JWN. The second question is the value of their stock. So the value of the stock, you got the dividend discount model, which you remember is dividend 0 times 1 plus long-term growth. And you divide that by KE minus long-term growth. We've got the cap earnings model. If you remember, that one is EPS 0 times 1 plus inflation. And yes, you just have to learn these formulas. Divided by KE minus inflation. The formulas, I have a tough time believing students complain about memorizing these formulas. First of all, you've got to know formulas if you're a business major. But secondly, they're almost the same formula 3 times. In fact, the H model, all we got to do with the H model is we take the dividend discount model. It's the exact same formula, except we're going to add that unusual, that high growth period in the middle of that. So we just add in plus dividend 0 times H times short-term growth minus long-term growth. The rest of the formula is exactly the same. So we got all our numbers here, so let's look at here. Dividend 0, that's given. Dividends last 12 months. It's $1.50 times long-term growth. Their long-term growth is 5%. It's given right there, so 1 plus 0.05. We're going to take all of that and divide it by the discount rate, 0.1. Remember, we did that in the previous problem. 0.1% minus the long-term growth, minus 0.05. And when you do all of that, you should get $31.50. And then we do, so there's your answer on the first one. Then we do the cap earnings. The cap earnings, we want EPS 1, and there it is, 3.30. That's given to us right there, times 1 plus inflation. Inflation is 2%. There it is right there. So plus 0.02. We'll divide that by the discount rate minus 0.02, and that should give you 42.08. If you're not getting these numbers, then just double check your parentheses. Make sure you're doing your parentheses correctly. And then the last one, again, it's going to be exactly the same as the dividend discount model, so I'm just going to copy that down. And then we'll do plus 1.50 dividend 0 times your H. All right, so what is my H? So I'll give you that information here. The continued growth in e-commerce, JWM has shown strong success. Your boss expects earnings growth to be 10% the next year. So there's their short-term growth rate, 10%. And their long-term growth rate is to 5%. And move back to the long-term growth rate over the next 6 years. For the next 6 years, what does that make your H? So remember, H is 1/2 of that. period of time are 3. So if you expect 6 years, then you make that 3. So we're going to do 3 times short-term growth. We say that's 0.1 minus long-term growth, 0.05. You put that together, and you get an H model valuation of $36. If your short-term growth is greater than your long-term growth, then you better get a higher price for the H model than you did for the dividend discount model. So that's the problem. Very basic problem. You just plug numbers into a formula. I'm amazed, and most students get this right, but I'm amazed there are students who struggle with this problem. I think some students just don't want to learn formulas, but you have to. You should know. I know students think, well, I'll just look it up. No, if you're a finance major especially, you don't look these formulas up. You just know them absolutely in detail. And you don't ever forget them. 30 years from now, you can still do these formulas off the top of your head. All right, then the next problem we'll break in between now and the next session. So we'll just get started this session so this video doesn't get too long. We're going to value their bonds. We're going to assume it's a 1,000-year bond. We want the current price of this bond. It's a 20-year bond issued 18 years ago. That means it is a 2-year bond. So we're going to use the 2-year on the spread, or use the 2 years on the risk-free rate. You don't care that it was a 20-year bond. All you care about is how much is left. So 20-year bond issued 18 years ago. There's only 2 years left. The coupon is 7%. And it's BBB rated. And it's BBB rated today. You don't care that it was A minus rated 18 years ago. That doesn't matter. All you care about is what it's rated today. So BBB. There's BBB. So there's our spread. And so what we'll do is we'll get our discount rate, KD, equals the risk-free rate plus the spread. So in this case, our risk-free rate is 0.026. It's the 2-year treasury because we're looking at a 2-year. Don't use it. I didn't give you the 20 years, so you don't have that choice. So 0.026, and then the spread is 85. So remember, the spread equals the basis equals. I mean, you convert the spread, you take the spread and divide by 10,000. I won't do that as an equal, that's going to make sense. But the spread, you take the spread divided by 10,000. So in this case, our spread is 85. 85 divided by 10,000 equals 0.0085. So 0.0085, you put that in there, and that gives you your KD. So your KD is 0.0345. And then what you have to do is you need your effective yield. This you'll just have to learn this formula. It's a formula everybody knows. The effective yield is 1 plus the KD divided by 2. And you raise that to 2 minus 1. So just have to remember that formula. And when you do that, you get an effective yield of 0.0348. Remember, your effective yield will always be greater than KD. Essentially what we're doing is we know this coupon, this 7%, is paid twice a year. Because it's paid twice a year, we want to compound that extra 6 months in there. So we're dividing it by 2 and raising it to the second power minus 1, so we get the discount rate. So 348 is what we're going to use for the discount rate. And then all you need to do is set up the table, and what the table will have is one column will be time, the next column will be the cash flows, next column will be the discount factor, and then your last column, I don't know why that typed that so badly, would be your discounted cash flows, and the sum of that will be your total. So time, we're assuming, well, we just know corporate bonds pay interest every 6 months, so our time is half a year, 1 year, a year and a half, and 2 years. Our cash flows, remember, our cash flows is going to be the face times the coupon divided by 2. So here the face is $1,000. That's given in the problem. Look up at the problem. It's $1,000. The coupon is 7% times 0.07 divided by 2, and that's going to give you $35. So there's our cash flows, 35, 35, 35, except the very last time it's going to be 1,035 because you get your principal back. So there's our cash flows. So next session I'll start right there and we'll finish up pricing this bond, and I'll include the 2 ways you can actually check your work and make sure you have it. So we'll stop it there just so this video doesn't get too long. So what I recommend you do is maybe before you watch the next video, see if you can finish this problem and get the answer, and then you're just checking it in the next video.